David Guttery is the Chief Executive Officer of inSOURCE Financial Advisors of Lincoln, Nebraska. David Guttery and Seth Edgell are financial advisors who represent Emeritus Investment Company, LLC, and Emeritus Advisory Services. Please stay tuned through the end of the video for additional important disclosure information.
Hello everyone, I'm joined today by David Guttery, Chief Executive Officer of inSOURCE Financial Advisors, to discuss the economy and the markets in 2025. David, thanks so much for joining us. Well, much has happened since our last interview. The election is behind us, and as you've said in the past, we have greater clarity now regarding the economy and investment opportunities as a result. So as you consider the new year, what do you believe to be some of the major development of which our viewers should be mindful in 2025?
Well, I think there are many ongoing themes that will likely continue toward resolution, and I also expect new economic developments this year as a function of the new leadership that we have in Washington and the anticipation of more pro-growth economic policies. In my opinion, the Federal Reserve has been under the microscope of the market for much of the last 4 years, and that will likely continue for the foreseeable future. As a subcategory under the Federal Reserve, we continue to monitor credit availability, lending restrictions, and costs associated with carrying leverage. Clearly, inflation will also remain in focus, and it continues to present a mixed bag of metrics. Inflation remains largely concentrated in areas that impact our lives on a daily basis, including food, fuel, and housing. But looking more broadly at the economy, inflation seems to be back to pre-pandemic levels, according to the latest CPI reading. The third major theme that we continue to watch pertains to a very narrow sleeve of artificial intelligence thematic stocks and the record-setting skew that these investments are having on the broader index. At a macro level, I am very encouraged about the prospects for 2025, both economically and with regard to investment opportunities. Having said that, we remain with risks in the market and threats to the economy of which we should be mindful and continue to navigate.
Well, David, those sound like very interesting topics for discussion today. So let's begin with your thoughts regarding the Federal Reserve and inflation. What do you see developing this year, and how might that impact households in the coming year?
In my opinion, market participants have spent the last 4 years in denial as it pertains to the Federal Reserve. I believe that Chairman Powell and the Board of Governors have delivered transparently on matters of policy. Several years ago, we talked about the potential for the expansion of the money supply to lead to higher inflation. And indeed, I believe that we can say that happened. And as a result, market participants began to anticipate the second coming of Paul Volcker. For those of you watching this video who are old enough to remember him as the chairman of the Federal Reserve in 1980, drastic measures were taken by the Federal Reserve to arrest the inflation under which we were suffering in the late 70s. While it is true we have recently seen the most aggressive Federal Reserve since that time, in my opinion it still doesn't rise to the level of being Volckered, as we have heard the term in the media lately. Indeed, we are now in a period of accommodation. So having said that, I believe market participants have once again not taken the Federal Reserve at their word. At no time did Chairman Powell suggest that accommodation would come through sequentially scripted rate cuts. Indeed, as of the last meeting of the governors, the anticipation calls for possibly 3 rate cuts this year, and the next rate cut might not occur until the middle of the year. If you think about it, this makes sense. Inflation, broadly, does seem to be under better control than at any other point in the last 4 years. It is also true that we have witnessed the longest streak in decades of inflation being above 3%. The rate of inflationary change does indeed seem to be moving in the right direction, but it has been elevated above 3% for 45 months. Why would the Federal Reserve risk rekindling the inflation that they have fought so hard to contain with haphazard rate cuts in machine gun style fashion? If this is what market participants anticipated, then I believe that was once again an irrational assumption as it pertained to the Federal Reserve. There are many reasons why the market is paying close attention to the Federal Reserve, and I believe that the impact upon the housing market is chief among them. I feel badly for the younger generation. It may be a while before most of them are able to afford a home. For this reason, owner's equivalent rent has been sharply higher as landlords have found historic latitude for rent leverage. According to many sources, including Case-Shiller and the Federal Reserve Bank of Atlanta, at no time in history has it required this much income to purchase a home. This is a historic departure from long-term trends. I do believe that this trend will ease and improve, but not in the immediate future. This will largely be a function of the Federal Reserve continuing to unwind their balance sheet from a historically bloated disposition. If they are successful in that endeavor, we could ultimately see that translate into lower mortgage rates. As this unfolds, I anticipate that it will incentivize an increasingly greater number of people that would have otherwise moved by now to put their homes on the market, and we should see inventories rise as a result. Again, in my opinion, this will take time to develop, but hopefully we begin to see positive signs of moving in the right direction over the course of this year. So to summarize, I believe that the majority of inflation remains in food, fuel, and owner's equivalent rent. Unfortunately, these are areas that impact us on a daily basis. So the perception is that inflation remains very high, while the broader economic data suggests that it's largely under control. I do believe that these metrics will improve throughout the year, but gradually and not acutely. At times when perception differs from reality, the resulting distortion can impact investment decisions, which is why we must remain vigilant and not satisfied with superficial observations. You must dig more deeply to determine whether perception regarding the Federal Reserve is rational or irrational. Often, irrational behavior can lead to investing opportunities for those with the intestinal fortitude to capitalize upon them.
Well, that sounds broadly reassuring that inflation could be of lessening concern going forward. Well, thank you for your insight on that topic. And as a sidebar, you have talked in the past about the balance sheet of the Federal Reserve and the abundance of Treasury debt available on the global market. Can you share your thoughts as to where we stand today on that topic?
Absolutely. I have described this in the past as being a glut of U.S. Treasury debt. Indeed, some of my clients are concerned that foreign nations may have the United States over a metaphorical barrel as it pertains to ownership of our debt. In my opinion, this again is an example of perception being different from reality. Indeed, it is the Federal Reserve that is the largest owner of outstanding U.S. Treasury debt. Mutual funds collectively account for the second largest weighting, and depository institutions, which are required to own Treasury debt, are one of the smallest domestic owners of U.S. Treasury debt. Indeed, China owns about 2% of the outstanding float, and collectively, international ownership amounts to just over 20% of the outstanding debt. What worries me the most is that all of the debt in the world, most of it belongs to the United States at just under 35%. This figure has significantly elevated in just the years since the COVID pandemic, driven by significant spending that was largely a function of not only the pandemic, but also spending to fund foreign conflicts, including Ukraine and Gaza. This has resulted in the worst 3 consecutive year period of time that we have ever seen for Treasury prices. Well, as we discussed just a few minutes ago, bond yields hit a 40-year high during this period of time, which translated into higher costs of carrying leverage that we have seen demonstrated in mortgages, for example. Clearly, nothing happens in a vacuum. The more Congress spends, the more deeply into debt we find ourselves as the U.S. Treasury auctions new pieces of debt to finance the continued spending. During the pandemic, the Federal Reserve debased the money supply by almost 36% in order to buy those treasuries onto their balance sheet, and today we have the dubious honor of being the issuer of the greatest percentage of the world's debt. By their actions, the ratings agencies are telling us that this cannot continue and that it is unsustainable. The Federal Reserve has indeed unwound its balance sheet by almost 12% in the last 2 years. And while that is a positive development, their balance sheet has nonetheless bloated by over 841% in the last 22 years. We keep talking about the potential for a soft landing here. Trust me when I tell you that, in my opinion, if the Fed is indeed successful at landing this softly, it will take a long time for that to happen. Are we a pig's country? Portugal, Italy, Ireland, Greece, Spain? No, not even close. However, it is also true that the U.S. debt to GDP ratio now stands at the third highest mark that we've ever seen. The last time it was this high was coming out of the hyperinflationary 70s, and it took the efforts of Paul Volcker and that Federal Reserve Board to arrest inflation, and hence why the market is so hyper-fixated on what the Federal Reserve does next today. Now, I do believe that over time this will moderate and return to levels of normalcy, but it will not happen overnight. So patience and attention to reality here is really the key.
Well, David, that is a fascinating overview, and you've offered much detail, and I believe our viewers can more fully appreciate why the market's attention is so focused on the Federal Reserve at this time. Hopefully, you're right, and this will moderate with time. The last topic on which we would appreciate your thoughts pertains to what we have called artificial intelligence thematic stocks. How is this having an impact on markets today? And what are your thoughts for the coming year?
Absolutely. For me, this is the 20,000-pound gorilla in the room. For those of us who remember Y2K, in my opinion, you can see very stark parallels between these two periods of time. One key difference is that I could circle January the 1st on the calendar of the year 2000. At 12:01 a.m. on that day, that crisis ended. We don't have that luxury today. Yet another panic-driven rapid adoption of technology. Yet this time it was inflation hitting a 40-year high that drove manufacturers to employ technology in an effort to make fewer of these things with the same profit margin, with fewer employees, and as remotely as possible. The difference is that today I have no discernible date on the calendar to offer to you as to when this might end. Can the Federal Reserve land its balance sheet softly? If so, when? When can I afford to buy a home again? When can I afford to buy a car again? When does inflation at the food and fuel level return to normal levels? These and other questions have nothing but soft, open-ended answers, yet we remain with what appears to be an overly valued and narrowly defined sleeve of stocks in the market. Can certain narrowly defined sleeves of stocks melt up without a rational spreadsheet justification? Yes, absolutely. It happened 25 years ago. Back then, Cisco, among other technology stocks, did that very thing. In the lead up to Y2K, the Federal Reserve once again made an enormous amount of money extremely available and almost free, very cheap. Companies largely borrowed and bought their way through the crisis. As a result, we saw a basket of technology skyrocket to untenably high levels. After the 1st of January, all the machines worked. Crisis is over. The orders dried up and the values of the stocks plummeted. These companies did not become 80% less valuable overnight, though. In my opinion, what we saw was a collapsing cascade of algorithms. Understand that the high-frequency trading that we had 25 years ago was driven by a horribly outdated technology by today's standards. Today, high-frequency, algorithmic-driven trading, through that, billions of dollars worth of securities can be exchanged in a matter of seconds. Now, I don't know if we'll see a similar phenomenon this year, but it will not surprise me if there is a retracing of gain among these stocks. How will that be felt in the marketplace? Well, at the end of last year, the 10 most heavily weighted stocks in the S&P 500 index carried a record 40% of the weight of the index. Let that sink in. For reference, you can see the Y2K event on this graphic. Where we are today dwarfs where we were in the lead up to the year 2000. The last time we saw a rapid adoption of technology when driven by a crisis. In my opinion, there's much Pollyanna in the media right now regarding about how this might impact the market. There are 503 stocks in the S&P 500 index, right? Yeah, but remember, they are all weighted by capitalization. This is not an evenly weighted index. Looking at a graphic such as this tells me that indeed the fortunes of the index could be largely driven by only a handful of stocks. I am seeing bombastic headlines such as this, and articles that go into detail about how the stock market might experience a long, sharp, and deep pullback this year. Well, I suppose that's possible at any time, and at a high level, I agree. In my opinion, the headline index itself might appear to be struggling should 10 out of 503 stocks retrace gain in a significant manner. However, it is also my opinion that much of the remaining market is undervalued, and as gains are harvested, those proceeds may find new homes in other undervalued areas of the market. It could be that while the index appears to be losing ground, investors notice that their accounts are appreciating in value. So once again, we can't be caught up with sensationalized headlines. You must look more deeply than just the surface to appreciate the odd period of time within which we find ourselves and understand how we got here. Those who forget history are doomed to repeat it. All we have to do is look back at other parabolic moves to see how events in the past have led to factions of equities becoming overly valued. You'll notice the magnificent 7 in red on this graphic. It would appear that we are nearing the inflection point where we have seen many other parabolic moves roll over and retrace gain. Now clearly, I can't predict when that will happen, but I believe it remains in front of us. So investors, in my opinion, should be aware of the premium they are paying as this AI thematic parabolic move continues to age. At a time when economic data suggests that manufacturing capacity should increase to meet increasingly greater demand for goods and services supported by increasingly lower inflation and capacity to consume widening, I have to ask, when does the market recognize that there is a shift away from being leaner to being bigger? That it may be unfolding today. Should that realization occur, then how does that translate into what seems to be overly valued, narrow sleeves of AI thematic stocks that were driven to these levels by an inflation crisis that seems to be resolving? Again, I can't give you a date on a calendar, but it hasn't happened yet, so it remains in front of us.
Wow, David, you've given us a lot of information today. So in closing, what advice can you give to our viewers that would be useful as we prepare to take advantage of the opportunities that lie ahead in the new year?
Well, first I would say that the economy is okay. It's not great, but it's not crashing either. Following the election, I believe that we can assume that the current tax code may be tweaked to accommodate nuances of where we are economically at the present time, but I expect it to largely survive intact. In my opinion, this will leave households with an increasingly greater capacity to spend, which may result in the economy gaining increasingly greater traction over the course of the next year. In response, manufacturers may be concerned with being bigger, not leaner, and hence where the fate of these AI thematic sleeves of stocks of the market becomes important. All right, well, furthermore, in my opinion, inflation could continue to moderate gradually. We'll begin to see the effects in areas that impact us on a daily basis. I expect that the Fed will continue to monitor the situation and be judicious with future policy moves. Lastly, I would encourage everyone not to be satisfied with superficial observations. Avoid bombastic headlines. Dig more deeply to gain a greater appreciation of the unusual nuances that permeate every aspect of the market right now. In my opinion, there remains a great disconnect between reality and perception, and often that creates opportunities for those with a willingness and the capacity to assume investment risk. Be disciplined, be vigilant, and research, and remain with a long-term focus on the accomplishment of planning goals.
Well, David, as always, thank you so much for your time. And for additional information, David may be reached through the means listed upon the following screen. For inSOURCE Financial Advisors, I'm Brannon Dawkins.
David Guttery and Seth Edgell independently offer securities and investment advisory services through Emeritus Investment Company, LLC, member FINRA, SIPC, and Emeritus Advisory Services. Information provided in today's segments is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.